Welcome, curious minds, to another deep dive. Today, we're plunging into the world of Glencore. Now, that's a name that constantly pops up in global markets, especially if you're keeping an eye on commodities.
Absolutely. It's hard to miss.
And Glencore isn't just, another mining giant. It's got this really fascinating dual identity. It's both a producer and a massive trader of the world's essential resources.
Right. And that blend is key. It gives them a high profile, truly eye-catching numbers sometimes, but also this track record of wild swings. It can leave investors scratching their heads a bit.
Definitely. So how do we make sense of this complex beast? Our mission today is really to extract the most important insights from some recent sources about Glencore. We'll focus on its market performance, future forecasts, and what truly drives its unique, sometimes, perplexing position in the global economy. Okay, let's unpack this.
It's a truly fascinating challenge, and you've really hit on the core of it there. Glencore's dual nature, being both a producer and a trader, it adds so many layers to its story, makes it quite distinct from, say, a pure play miner. And our sources today, they present some really compelling and, sometimes contrasting perspectives on its investment potential and, the broader market forces swirling around it.
Contrasting is a good word for it.
Yeah. I mean, when you have a company that digs the copper out of the ground and trades it on the global market, you're just looking at a different set of risks and opportunities. It raises a really important question for us and for you listening. How do we navigate these different viewpoints? How do we figure out what's truly happening with Glencore, especially when the headlines can be so contradictory?
That dual identity really is crucial, isn't it?
Yeah.
And it helps explain why Glencore's journey has been, well, to put it mildly, a roller coaster.
Yeah, understatement perhaps.
I mean, when you talk about mining stocks generally, you're talking about some of the most cyclical assets out there, right? They're so heavily influenced by global economic health.
Totally dependent.
And Glencore is just a prime example. Their annual profits and, crucially for investors, their shareholder dividends, they can just swing wildly depending on what the global economy is doing.
We've seen it happen.
We really have. Since Glencore lifted on the London Stock Exchange back in 2011, its payouts have been, well, the source said up and down like a seesaw.
Yeah, that sounds about right.
And recently they've sunk a bit, mainly due to China's economy, spluttering somewhat, and higher global interest rates hitting demand for commodities across the board.
Right.
But just a few years before that, they rose really strongly as the post-pandemic recovery drove metals and energy values sky high. It really embodies that whole boom and bust cycle.
It really does. And yet, despite some of those recent downturns you mentioned, it's quite interesting to see that city analysts are actually painting a remarkably optimistic picture looking forward.
Oh, really? How so?
Well, they're tipping Glencore shares to rebound pretty strongly over the next few years. And they're forecasting some truly, stunning dividend growth.
Stunningly.
Like for 2025, they're looking at 14 US cents per share. That implies about 40% growth from current levels, giving a 3.8% yield.
Okay, 40% growth, that's significant.
It is. Then, by 2026, that forecast jumps to 22 US cents. That's another massive 57% growth for a 6.2% yield.
Wow.
And the truly eye-popping one is for 2027, an incredible 34 US cents. That's another 55% growth, projecting a 9.6% yield.
Nearly 10% yield. That's huge in today's market.
It's massive. And importantly, this expected dividend growth lines up with a strong anticipated bounce back in profits. Analysts expect Glencore to swing from losses of 13 US cents per share last year to earnings of 20 cents in 2025, then 33 cents in 2026. It's up 65% year on year, and then 44 cents in 2027, another 33% increase.
Okay, so the earnings are expected to support those payouts. That's the forecast. And this kind of growth, it far outstrips the expected dividend growth of just maybe 1.5% to 2% for the broader FTSE 100 index over the near term.
Right.
And it means Glencore's projected yields, shoot way past the FTSE's long-term average, which is usually between 3% and 4%. So what's fascinating here is just the sheer scale of the turnaround analysts are predicting.
That's a serious vote of confidence from the analyst community, putting out numbers like that. But okay, here's where it gets really interesting, I think. This highlights that tension we mentioned earlier. While the analysts are painting this incredibly bullish picture, one source we looked at, an investor sharing their experience, described it as a horror show. Glencore's share price was actually down 37% over the past year for them.
Ouch. Yeah, that's a big drop.
It is.
Yeah.
Now, to be fair, for longer-term holders, the shares are actually up around 65% over 5 years. So it depends heavily on your time frame.
Absolutely. Timing is everything in cyclicals.
It really is.
Yeah.
That just underscores the huge difference between short-term market sentiment and maybe the longer-term potential in this volatile sector. And the immediate numbers certainly reflect that short-term pain. Glencore's adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, kind of a key measure of operational profitability.
Yeah, a standard metric.
That was down 16% to about $14.4 billion in 2024, and operating profit plunged 33% to $7 billion.
Those are significant drops.
They are. Even their Q1 results showed continued weakness, especially in copper output, although cobalt, coal, and zinc production did see some increases. So we've got this really fascinating contrast, expert predictions of soaring future performance versus, well, recent tangible underperformance. How do we reconcile that?
That is the million-dollar question, isn't it? And it brings us to a really crucial point, one that often gets overlooked when you see these enthusiastic forecasts. Dividends are never guaranteed.
Right. Always the fine print.
Exactly. While Glencore's predicted dividends are quite high, as we discussed, they are covered between only 1.3 to 1.5 times by expected earnings through to 2027.
Okay, 1.3 to 1.5 times cover. Is that good? Bad?
Well, it sits far below the sort of safety benchmark analysts often look for, which is around 2 times cover.
Ah, okay.
That 2 times level is generally seen as safer because it means a company's earnings are double its payout. It gives you a significant buffer if earnings unexpectedly drop.
So Glencore's lower cover suggests more risk.
A greater level of risk, yeah. It means those impressive future payouts are potentially more vulnerable if unexpected market shifts happen. And let's face it, those shifts are always a possibility. We can't ignore the ongoing macroeconomic uncertainty, including fears of a global slowdown, and crucially for commodities, things like China's retaliatory tariffs, which have certainly impacted trade.
True, the macro picture is still murky.
It is. Although, to provide a balanced view, there are some signs of a possible rebound in China, improving factory activity, exports picking up, government stimulus measures are in play, and maybe even an uneasy truce in the U.S.-China trade war.
So some green shoots, maybe?
Possibly. However, it's also worth noting the OECD recently cut its global growth forecast down to 2.9% for both 2025 and 2026, signaling headwinds. So while, fortune often favors the brave in investing,
Yes.
it would certainly take a brave investor, I think, to consider buying Glencore today, given all these conflicting factors and those underlying risks, particularly around the dividend cover.
It really sounds like a true high-wire act, doesn't it? Balancing that potential reward against the very real risks. But that's actually a great segue, because what's becoming undeniably clear from our sources is that copper is arguably the critical commodity for Glencore's future.
Copper.
It makes up roughly 20% of their overall commodity basket. So the question isn't just if copper is important, but why is it so vital right now? And what does its future trajectory specifically mean for a company like Glencore? What's driving this immense focus on copper?
It's truly a pivotal moment for copper for a few interconnected reasons. The IEA's Global Critical Minerals Outlook 2025, it provides some really compelling data that paints a clear picture.
Okay.
Global refined copper demand, and this is excluding scrap metal, hit nearly 27 million tons back in 2024. And it's projected to grow significantly to 33 million tons by 2035, eventually reaching 37 million tons by 2050.
That's a lot of growth.
It is. And it isn't just about traditional industrial growth anymore. What's fascinating here, and a major new force behind this rising copper demand, is the rapid expansion of AI data centers.
The AI factor.
Exactly. For example, new U.S. data center capacity is expected to grow 5-fold between 2023 and 2028. And here's the kicker. Each gigawatt of that capacity typically uses about 5,500 tons of copper.
Wow, 5,500 tons per gigawatt.
Yeah, just think about the scale of infrastructure needed for all those AI models, and the processing power. It's immense, and it's a demand driver that, well, barely existed a few years ago at this scale.
That's a staggering amount of copper, just for data centers alone. It's not just about wiring new homes or traditional manufacturing anymore. It's the digital infrastructure of our future that's really hungry for this metal.
Precisely. Now here's the core challenge, the thing that makes copper so strategically important for Glencore and, frankly, for the global economy. While demand is surging.
Supply.
Exactly. Global mined copper supply, which was 22 million tons in 2024, is actually set to peak in the late 2020s at just over 24 million tons.
Peak, so it goes down after that.
After that, it's projected to drop below 19 million tons by 2035.
Why the drop?
It's largely due to things like falling ore grades in existing mines, meaning you have to process more rock to get the same amount of copper, and the closure of older, less profitable operations. It's getting harder and more expensive to get it out of the ground.
Okay, so demand up, supply potentially down. That sounds like a squeeze.
A big one. The IEA, under their stated policies scenario, which is basically their baseline projection, assuming current government policies continue, they forecast a significant 30% copper supply deficit by 2035.
A 30% deficit, that's huge.
It is. And that gap widens even further under more ambitious decarbonization scenarios, which rely even more heavily on copper for electrification.
Right, EVs, renewables.
All need copper. Add to this China's role in copper smelting. Its rapid growth in smelting capacity is actually causing a global squeeze on copper concentrate supply, the raw stuff from the mines. It's leading to losses for smelters worldwide because they just can't get enough raw material feed.
So bottlenecks all through the chain.
Pretty much. This whole imbalance, coupled with supply disruptions like the big shutdown of the Cobre Panama mine, contributed to copper prices surging up to nearly $10,800 per ton early in 2024. So, yeah, we're looking at a fundamental supply-demand imbalance that could dramatically reshape the market for this critical metal.
Okay, so if copper is projected to be in such high demand with this looming deficit, how is Glencore, under their CEO, Gary Nagle, positioning itself to, well, capitalize on this? What's their strategic playbook to optimize for this future? Especially given the forecasts and the market conditions we've discussed, it really seems like they have a unique opportunity here.
They absolutely do, and their leadership seems to have been very deliberate in their strategic moves. It's almost like a carefully orchestrated chess game, looking at the sources. First, they've been intensely focused on portfolio simplification.
Okay, what does that mean exactly?
It means they've strategically shut down or sold off more than 20 assets that were either consistently losing money or just too small to really move the needle.
Tidying up.
Exactly. It isn't just about cutting costs, it's about refining their core business, leaving them with a more focused portfolio of what they call terrific, long-life, low-cost assets that are well-diversified globally. This reduces their overall risk profile and lets them focus capital where it generates the best returns.
Makes sense. Pruning the dead branches to let the healthy ones flourish.
Precisely. Second, they're prioritizing organic growth, especially in copper. They've been actively enhancing their existing projects and exploring new ones within their current land holdings.
So growing from within.
Right. And what's truly impressive is their resource base, their measured, indicated, and inferred copper resources. It stands at close to 20 billion tons.
Billion, with a B.
With a B, which is a growth of more than 6 billion tons since 2022 alone. This massive resource base isn't just a number, it sets them up for significant future development. It essentially gives them the raw material in the ground to grow their copper production internally when the time is right.
Got it. And third.
Third, and perhaps most strategically, is their approach to mergers and acquisitions, M&A. They haven't just bought stuff randomly. Each acquisition seems to fit a very specific long-term vision.
Like what?
Well, for example, in 2024, they made that significant $7 billion acquisition of EVR, the steel-making coal assets from Teck Resources. They described it as a Tier 1 best-in-class asset, very cash-generative, long-life, low-cost. This is about securing top-tier, efficient production.
Okay.
They also made some incredibly smart, maybe even contrarian acquisitions in thermal coal, including buying Sarahan and buying out minority joint venture partners at a time when, as CEO Gary Nagle put it, coal was a four-letter word to many investors.
Right, when everyone else was running away from coal.
Exactly. This counter-cyclical move added over 20 million tons of annual coal production for less than $300 million, leveraging existing top-tier assets in Australia when others were divesting. It's about buying quality assets cheaply when sentiment is rock bottom.
That's a bold move going against the grain like that. It suggests they have a long-term view that's very different from the sort of short-term market consensus.
Absolutely. They also became 33% owners of Eleanor, which they highlight as the biggest and lowest cost alumina refinery outside of China, positioning them in another critical base material.
Alumina, right.
And crucially for the future minerals landscape, they merged assets with Teck into the Polymet project in Minnesota. The aim is to advance it for critical minerals like nickel and copper. They emphasize this is a brownfield project.
Brownfield, meaning?
Meaning it's an expansion or restart of an existing site rather than building a brand new mine from scratch, which is called a greenfield project. Brownfield typically means low capital intensity, lower upfront investment costs, and usually a faster path to production.
Ah, less risk, quicker returns potentially.
Generally, yes.
Yeah.
They also picked up the remaining stake in Mara in Argentina, another leading brownfield project that's essentially an extension of an old asset, further consolidating control over efficient, established operations.
Okay, lots of M&A activity then.
Yes, but very targeted. Now, here's a really crucial nugget, something that isn't immediately obvious if you just look at the balance sheet numbers. It's what they call the hidden value of copper in the ground.
Hidden value. Tell me more.
Glencore, according to Nigel, already has the copper resource in the ground to potentially double their current production.
Double it.
Double it, which could increase their share to maybe 8% of the total global yearly copper supply. But, and this is key, they are strategically waiting and keeping their value in the ground.
Why wait? Why not just produce it now?
This isn't out of idleness. It's a deliberate strategy, apparently, to avoid destroying prices. They're essentially sitting on a massive reserve, acting almost like a potential market stabilizer, planning to release supply only when the market truly needs it and when prices reflect that underlying demand.
That's fascinating. So they're not just digging it up as fast as possible. They're sitting on this potential treasure trove, almost like a central bank for copper supply,
Right.
but holding back to maintain market value.
That seems to be the idea.
It completely shifts the perspective, doesn't it? From a company focused purely on extraction volume to one that's strategically managing its impact on global supply and price.
It does. It suggests a sophisticated long-game strategy that positions Glencore potentially as more of a price maker, not just a price taker, especially in a future world where copper might be constrained. It really challenges that conventional wisdom of just dig it up now.
Very interesting. Okay, what else is in their playbook?
Well, adding to this, CEO Gary Nagel actually views buying back their own stock as their biggest and best form of M&A.
Buying back their own shares as M&A. How does that work?
His logic is, why buy another company when you can buy your own assets, which you know intimately at what you believe is a discount? They've bought back nearly 10% of Glencore stock, that's over 1.2 billion shares, for over $1.2 billion in the last, say, 3 to 3.5 years.
Okay.
Nagel states there's zero takeover premium, zero due diligence needed because, well, they know their own assets better than anyone. He even describes it quite provocatively as taking our company private by stealth.
Taking our company private by stealth. That's a bold statement.
It is. He says they front-run that re-rating, essentially buying back stock while it trades at what they see as a discount before the market fully recognizes its true value. So this strategy isn't just about boosting earnings per share. It's framed as value creation from within by acquiring assets they know intimately at a perceived bargain price.
That really speaks volumes about the confidence they have in their own, perhaps undervalued assets and their long-term vision.
It certainly does. And finally, just looking quickly at their key growth projects, specifically for copper, they have several exciting prospects that could underpin their future supply.
Like that.
There's Caraco in Peru. It's described as a very low capital intensity project, meaning relatively little upfront investment needed. It's effectively an extension of their existing Antapaccay mine.
Okay.
This project could apparently bring 300,000 tons of copper equivalent production to market the quickest if a significant copper deficit truly materializes. It positions them for a rapid response.
So speed to market is key there.
Seems so. Then there's Mara in Argentina, another brownfield project, basically an extension of the old Alumbrera mine. It's capable of producing 200,000 tons of copper equivalent per year for over 20 years, also described as low capital intensity, indicating efficient expansion potential.
Another efficient one.
And lastly, El Pachón, also in Argentina. Now, this one is a greenfield project, a completely new mine development. Glencore approaches it cautiously, Nagel says, because greenfield projects are naturally more capital intensive and take longer to build.
Right, bigger risk, bigger investment.
Exactly. But it's described as an unbelievable deposit that, once developed, will be one of the top 10 copper mines in the world, producing well over 300,000 tons annually for decades. Their stated aim is to massively de-risk its development before committing fully, which showcases a prudent approach to these huge long-term investments.
Okay, so to try and bring this all together, we've seen Glencore as this company deeply embedded in cyclical commodity markets. It's facing immediate challenges like the macroeconomic slowdown and that investors' horror show in the short-term share price.
Yeah, the recent past has been tough for shareholders.
Yet, at the same time, it holds these significant long-term assets and strategic advantages, particularly in copper, with those massive hidden reserves and clear growth projects lined up. It's a real tension, isn't it, between the analysts' strong buy recommendations and high forecasts projecting those stunning dividend yields.
Almost too good to be true.
Well, maybe. Versus the individual investor's recent experience and perhaps caution about that shaky dividend cover and the ongoing global uncertainties. It feels like a company with a strong foundation and a clear strategy, but operating in a world that's anything but predictable.
Absolutely. And if we connect this to the bigger picture, Glencore's story tells us so much about investing in these cyclical industries, doesn't it? Especially when essential commodities like copper face a projected supply deficit, driven by these monumental global trends like AI data centers and decarbonization. This company isn't just riding the waves, it seems like it's actively trying to shape them, or at least position itself optimally for them.
Oh.
This really raises an important question for you, the listener, to think about. How do you weigh the certainty, or perhaps the perception of certainty, of short-term market swings and the very real pain of immediate share price declines against the potential of that hidden value, like all that copper still in the ground, and a long-term strategic positioning designed to benefit from these huge mega trends?
Yeah, it's the classic short-term versus long-term dilemma, amplified.
Exactly. Is successful investing here about patience, just waiting for the market to eventually catch up to the potential value? Or is it about trying to pick the absolute right moment to get in, which, as we know, is notoriously difficult, especially in volatile markets like commodities? What aspect of Glencore's complex story will you be watching most closely going forward?